Okay, welcome everybody to Marsden Jacob Talks Live. Today's topic, European Energy Crisis, Lessons for Australia. At the outset, I'd like to do an acknowledgement of country. Marsden Jacob Associates acknowledges the traditional custodians of the lands and waters across Australia where we conduct our business. We also pay our respects to their ancestors and elders past and present and leaders emerging. Thanks everybody for joining us today. I'll just let you know that the session is being recorded. The presentation part involving myself, Cameron O'Reilly, Associate Director at Marsden Jacob, and Philip Lewis, Founder and CEO of VaasaETT, will last for around 30 minutes. Presentation section will be available to view after the event, but the Q&A section is recorded but not published. We will email participants a link when it is available. I would particularly initially like to introduce Philip Lewis, who will be speaking later. Philip, I've known for around 15 years, and he's joining us at 6 a.m. Helsinki time this morning to talk about the European crisis. I'd particularly like to thank him for joining us at such an early hour and to share his insights with us. Philip is a renowned European retail energy markets thought leader, founder and CEO of global energy consultancy VaasaETT, and co-founder of Smart Energy Europe and the Traxys Group. For over 25 years, Philip has been a pioneer of market analysis, supporting consumer-focused competition, new business models and energy transition in over 100 energy markets for governments, regulators, utilities, innovators and investors. Philip's high-level public project work has included Director of the European Commission's 2021 project identifying barriers to European markets. He's also been consultant in the ACCC's review of prices and competition in 2018, so is very familiar with Australia and Australian energy markets. During the energy crisis, VaasaETT has been the European Commission's primary source of timely European retail price data and analysis. So welcome, Philip. As I said, I've known him for 15 years and first met him while CEO of the Energy Retailers Association of Australia. And I've always shared and valued his insights into retail markets and global energy pressures. I've also subsequently joined Marsden Jacob Associates as an Associate Director after spending 3 years in the Energy Policy Unit of the New South Wales Department of Planning, Industry and Environment. So today we're going to address the European energy crisis and its relevance to Australia. So why this topic and why now? Well, first of all, we're looking at it in terms of what Europe's experience means for Australia. Of course, Europe is such a significant part of the world economy, it can have an influence on Australian energy markets as a major exporter of fossil fuels. But also European experience can also give us guidance on what may occur in terms of regulatory responses and consumer reactions and market reactions to developments going on in global energy markets. And what we've seen, I think, this year is that 2022 has been a dramatic year in Australian energy markets. And it's not to talk simply in the past tense, more could yet happen. 2022 has plenty of time to run. But I think what we do know is that events in Europe have already impacted Australia, and they've impacted global commodities markets, particularly for coal and gas and all forms of energy. And Europe is now moving into winter 2022-23. And in Europe, energy use peaks in winter. At the same time, Australian energy markets, electricity markets, tend to peak in terms of overall consumption, not so much peaks of use, at least in summer. Although what we've just seen during winter, we can certainly see very high demand periods. And what we know, and what we will hear later from Philip, is that European energy shortages and disruptions are likely to continue impacting European markets and global energy markets. So what does this mean for Australia, and what can we learn from the events in Europe? If we can move on. So just to set the context in some ways of the impact of Europe to date on Australian energy markets. And I say that it's been not just Australia, it's been the globe. And of course, if you see global LNG prices, the top graph is the market for LNG globally and the price in British thermal units, which has reached over $40 US per million British thermal units. And then the bottom graph is the Newcastle Black Coal Index, which as of today, the futures were showing prices of US $440 a tonne. So we are unprecedented territory in global gas and coal prices. And if we go back through this year, it was the 24th of February this year when Russia invaded Ukraine. It was towards the end of the European winter. We are now really, as it enters a new winter and the war continues and its impact on global energy markets continues, we are about to see how much that ongoing conflict can really impact both Europe and the world. In March this year, the EU committed to reducing use of Russian gas by 66%. Philip will update us on how that is going. Now, in energy context, such a large user as Europe, restructuring its sources of energy is going to have a flow-on effect to global markets, as it did. As we saw in those graphs, the LNG prices lifted, but so too did Australian gas prices, because we, as the largest exporter of LNG in the world, have an enduring export link in our gas markets. But we've also seen that all energy sources have been lifted, and Newcastle black coal prices have also surged in response to the sanctions against Russia. And in an electricity market where in 2021-22, 48% of NEM output came from black coal, that is a significant factor. If we can move on. And what we've seen is those commodity price impacts have played into events in Australia, which were country specific, but were in many ways influenced by, and the seriousness of that situation influenced by, those high commodity prices. So in winter 2022, we saw those high commodity prices coalesce with significant outages in our coal thermal generators, lower semi-scheduled or renewable generation output, and simultaneous cold weather across the eastern states. As a result, we saw a significant wholesale price surge across the NEM. We saw increased use of gas power generation and high heating demand right across Eastern Australia, particularly in Victoria, which put spot gas prices to record levels of up to $40 in the short-term trading market. We then saw the market price cap imposed initially in Queensland, then New South Wales, Victoria, and South Australia. And then we entered unprecedented territory where, in response to constant directions and the response to the imposition of the market price cap, we saw the NEM suspended from the 15th to the 24th of June this year. Now, those high wholesale prices, of course, starting from earlier this year, have begun to flow through to the retail market, and the default market offer across the NEM was increased from 1 July, but did not take account in many ways of some of the later surges in wholesale prices, particularly around winter. And what we've seen is obviously some disruption in the retail market. Retailers, we've even seen roller events, retail of last resort, triggered, and we've seen many retailers stop selling to customers. We've also seen some of the larger players' financial results impacted. So as we approach summer here and Europe enters winter, what can we expect? Well, now let's turn to hear from our guest speaker, Dr. Philip Lewis, who I previously introduced, but now would like to particularly thank for participating in today's webinar, and we really look forward to sharing his insights. Thank you.
Hello, everyone. Thanks a lot. Great to talk to you all today. And thanks, Cameron. Really great introduction. So, and fascinating to see the parallels between Australia and Europe. Okay, so I'll get right on. Just to say, first of all, that I'm not here to scaremonger. I'm not here to kind of lay any blame in the European situation. more to simply show the situation as we see it at the moment in Europe, what is happening, and some of the possible remedies to that or solutions to that, whether temporary or not. And to look first of all at Europe's gas crisis then as a whole, and then dig a little bit deeper into the actual consumer situation as we go along. So now we all know that Europe is very dependent on gas. That will be apparent to all of you by now. That's a very major issue that Europe has at the moment, that it has been so dependent, it is so dependent on gas. And that is especially the case at peak times, and especially at critical peak times. And just a few facts for you here. So about 400 BCM consumed in the EU, and I'm not including Great Britain, United Kingdom in that, but actually that would then take that even further. And in some of this presentation, I am including the UK, and I'll try to explain when that is. But anyway, 400 BCM consumed. 20% of the primary energy consumption of Europe is from gas, and for 32% of households, it's the primary source of energy. And then 60% is imported. You always have to be careful with whether Norway is or isn't included. That's excluding Norway. In some stats, you'll see actually Norway is considered an importer, but actually here we're considering it part of Europe. So 60% is imported. And also gas is a major source, as we see on the right here, of power generation, extremely big source of power generation. And that's one of the issues for potential outages in Europe because of this gas prices. And but the thing is to remember that gas has been seen as a major counterpart in decarbonization. And right before this crisis, it was actually increasing in significance. And it was actually increasing as a tool to try to enable Europe to decarbonize. And of course, that we couldn't have necessarily foreseen the problems that were happening, but that has made the issue worse. Next slide. Now, if we look at the imports to Europe, and this graph shows the different mix of import sources or import categories into Europe of gas, you might argue that actually, well, look at it, August now compared to August a year ago, actually we're at a similar level of imports and we're managing it and everything should be okay. That would be at first glance a possible view on this if we go to the next slide. However, if you look at there, the amount of Russian gas, so that area at the bottom there shows the Russian gas as a share of the imports, and you'll see that it has declined very rapidly. There is still some left. Some of that includes Russian LNG and the remaining sources. Now that also, when we drew this graph just last week, actually it included the Nord Stream that has now been taken out. And if you take out that Nord Stream, I'll show you in a moment what that then does. But we also have to remember that there's way more Russian gas, well, what you can see there, still remaining. And that is a big concern because that may also now go out. If you see that dark blue area, that's the other LNG. And as you see, LNG from other sources has increased massively from the USA, from Norway, and so on. The concern is that those are now constrained and the other sources of LNG replacement are constrained. And this is a concern going forwards because more Russian gas is likely to be taken out. We need to therefore replace with more alternative energy imports, gas imports, and we are still at a low level of demand at the moment in Europe. If we go to the next slide. So the concern is that, as that arrow shows, the red arrow, that if we lost the rest of the Russian gas, that would be the situation that we are in terms of what the imports support or what the import level is. And so we need to then replace even more as a result. And that is at a time of year when the demand is low. And the big concern there is what's going to happen in winter time for heating. So how do we fill the gap between that dotted line there and the peak level of imports that we will actually need to support going forwards if that remaining Russian gas is taken out? And that is essentially the concern that we have at the moment. So if you move on to the next slide. So one of the solutions to this, of course, is storage. Okay, where Europe is rapidly and some might say desperately trying to increase storage levels. The target has been around about 80%. Some markets are above 80%. Some are well below 80%. If we look at the average level there compared to former years, we see that actually there is still some way to go in Europe in order to reach the kind of storage that we would want, and even to be up to levels that we've been at some point in the future. Now, even if we did get there, which we probably won't, but even if we did get to that 100%, it would support maybe 30 to 40% of average EU winter consumption. And now that, therefore, is not taking account of a really cold winter where we would need even more. So it would support some demand for some time. But if there's very, very high demand, there is a concern that it won't necessarily provide that much backup for the energy that we might need. If we go to the next slide. So controlling demand will be absolutely essential, but even if we do that, we're going to have problems. Now, so the calculations behind this are very difficult. The math is very, very difficult to figure out the net inflows and outflows across Europe between European markets. Just take one market in particular here. This is France that we're looking at here. And of course, there will be debate over whether the numbers are correct or not. But they're all different kind of numbers. But we've taken numbers here that we can ascertain. Now, the blue bar there shows the peak load from the last 5 years. And we're looking here at Q4 for 22. So the peak load from the past 5 years would be that 94.5 gigawatts. And that's kind of theoretically what might be needed in terms of generation to support. Now we're looking here at electricity, by the way. Now, if we then look on the left-hand side bar, we see the actual total capacity estimate that could be realistically fulfilled. And that includes nuclear, it includes other energy types, and it also shows realistic, what we think is, from the statistics that we've found, realistic import levels. If you look at that situation, you see a shortfall there. And that is what we're sort of seeing as the issue in a number of markets right now, is there a possibility to really meet that demand that is actually needed in those markets? A lot of that will rely on what's happening in the rest of Europe, of course. And but we really have a perfect storm in Europe at the moment. We have nuclear maintenance in France at the moment, approximately, I think it is, and it's changing, but I think it's about half of the nuclear fleet that's out for maintenance. We have low water levels impacting nuclear, hydro, fossil. We've had a big water shortage in Europe this year. We're relying a lot on Norway as a backup plan, but now Norway is starting to say that, well, water levels here are low. We may not be able to back you up as much as we would like to. And that's worrying a few people. Also, as we saw before, import levels, they're kind of maxed out to a large extent. There are plans, longer term plans to increase it. But the short term situation, especially for this winter, is looking concerning. And we have a lot of wind and solar. We don't have a lot of storage, and that's a big concern. We also have more coal and other nuclear generation that, in theory, could be reinstated. But anyway, not quick solutions in most cases. Also, of course, a lot of discussion on the gas side about North Sea gas. And of course, these are not immediate solutions for this winter. Also, there's been an underinvestment, I would say, in demand side flexibility. We're very concerned about national protectionism, whether some markets will necessarily share their energy with others if they're in difficulties themselves. We hope that Europe will do that. We're assuming Europe will do that. But of course, there are always concerns about that. And just to be really clear, governments had lots of plans for all sorts of situations. I don't think any market that we've seen really had a genuine plan for what has happened, this long-term outage risk in Europe for such an issue was never really planned for. Go to the next slide. So we have a very precarious situation for a whole load of reasons that are happening. Now, the question is, and what does this mean for the retail market? Well, if you look at those previous years, actually the retail market was pretty flat for a long time. It was increasing, but it was relatively flat, relatively stable for many years before this moment. Then COVID came. Next slide. And then you see that the price, and just by the way, the dark blue line there shows the all-in price, and the 3 lines below it show the component parts. And if you add those component parts, so energy, distribution, and taxes, VAT, then you end up with the top line there, the end user price. But so when COVID happened, the demand fell, prices fell, and then they started creeping up. Then we had the energy crisis. Next slide. And when the energy crisis happened, we started having pretty rapid increases in the energy component, and therefore the price went up. Mind you, at the same time, there were some reductions in taxes, deliberate, in order to try to compensate for that. But as you see, it didn't really have a big impact on the overall price. And then, next slide, the war in Ukraine happened, and suddenly massive increases. This is just for electricity, so a 70% increase in the price compared to pre-COVID levels. That's a pretty big increase in electricity prices across the EU 27. Just mindful that does not include Great Britain, but we'll look at Great Britain later. And then but this is for electricity, 70% increase. If you next slide, you'll actually see that gas is way worse, of course, 129% increase in retail prices. And I would just say that this is based on research that we do every month. It's called the Household Energy Price Index, and this is from that research that we collect every month from all European markets. And but massive increases in price. And one thing that you notice there, and we'll explain it later a bit more, is that whatever those other energy components are doing, whether you're trying to compensate them through policy measures, at the end of the day, the energy component now is so dominant that it really does set the total price. So the next slide. Now, the thing is that, skip, thanks. And then, so some markets have favored or fared better. Some markets have fared worse, depending on their market structure, the price caps, price regulations, and other measures. But essentially more than that, based on the fundamentals of their specific market. I don't have time to go into this right now, but you do see differences in the way that market prices are going, apart from France at the moment, which is a bit different because it has a pooling mechanism for energy, for nuclear, and also regulated price, so it doesn't go up. But in other markets, they have all gone up, and they're going up and up and up and up. And this particular graph here just shows to July, but the other graphs go to August, which we have the latest data out today, in fact, for August. But only time will tell which end up better, because they're changing positions all the time. Next slide. One of the problems that customers face is that it's really hard now in Europe to get an offer. In some markets, or most markets, you'll go to price comparison sites and you'll look at what you can get. They'll have companies, you'll click on them and nothing happens and there's no offer. Very few offers in the market. Where there are offers in the market, they tend to be very high, and there are very few fixed term prices. The fixed term prices are extremely high. Most people are now ending up on variable term contracts, and that is putting them in a vulnerable position. Also, a lot of consumers are moving to safety net prices, and those safety net prices are also increasing in many cases. And that's what's happened in Great Britain with the price cap, and we'll go into that later on. But so because of that, customers are essentially in a very vulnerable position. They're on very often very high now fixed term contracts, or they're on variable contracts, which are going up and up and up and up, or they're coming to the end of their fixed term contract and thinking, heck, what do I actually do now? What's my option? Well, to be honest, the only real option, if you're coming off of a fixed term or on a variable term, is to save energy. That's really the only thing you can do right now. Next slide. And also just to say that the retailers are changing their behavior as well. Now, prices, this graph is a bit complex, but shows the correlation between wholesale and retail. And right now, over the last year, there's been a massive increase in the correlation between wholesale and retail. prices are changing quicker, sooner, and tracking wholesale way, way more. That's partly due to the tariff mix change, more variable, but generally speaking, the prices are becoming more volatile. Next slide. But we tend to hear this complaint that the retailers have all been reckless and they haven't hedged. Well, the reality is that generally speaking, if you look at year ahead prices correlated with retail prices, it's very close. And France is a different matter because of the way the market's regulated. But just a few examples here, you see that the correlation is pretty high with futures prices. For example, companies have been hedging very well. The reality is now, because of falling liquidity, it's getting harder and harder to hedge. And in the liquidity crisis in Europe is acute right now. And this is why a number of markets now are bailing out suppliers through liquidity guarantees. And that's happened now in Sweden and Finland already. Sweden have provided, I think it is about 24 billion euros worth of liquidity guarantee into the market, and Finland about 10 billion already. And there will be many more that are doing that. There's discussion even about Great Britain. So liquidity is becoming a problem. This is actually making hedging and participation in the market more dangerous and more difficult. Next slide. And so what has happened? Governments have taken big steps. There have been big measures from governments to protect customers, as well as to protect suppliers now. And in some cases to make changes to the wholesale market, which I'll explain a bit later. But essentially, there have been a number of measures by governments. In fact, 58% of European electricity markets have taken measures to protect customers. And only a couple of them have ended those during the crisis. The rest are still doing it in the form of VAT reduction, energy subsidies, compensation, price caps. Now, the net effect of all of that, as you see here, the dark blue line, is to heavily reduce prices, at least in the short term. And what we've found is that the electricity price as of July would have been about 22% higher without those measures. So the massive prices that we see at the moment are still not reflective of how the market would look if there were no protections of these kinds in place. So the question is, what happens if this crisis goes on and on and on? Next slide. So the other impact of this market is that the suppliers are not making any margins, of course. So if you look at the way the wholesale has increased and the way that the retail prices have increased, although the retail prices have increased massively, they can't keep pace with the wholesale price. Now, if you just look at indicative gross margin, we're not saying this is actual gross margin, but it's just a metric looking at the comparison of the wholesale versus retail component. We see that the indicative gross margin has gone horribly negative. And this is a big issue because a lot of countries are talking about trying to cut the prices of retailers. Well, you can't cut the prices of companies that have zero margin or negative margin. So where's the fat to cut? Next slide. So therefore, just look at Great Britain as an example then of one of those measures that has been taking place. Now, Great Britain has a price cap, as they say, a backstop protection from the government to basically help protect customers. But has it protected customers? Well, of course, even in Britain, you will see that the price cap is lower than the alternative fixed term, say, tariffs in the market. But that's true in any market that the fixed term contracts are higher. And of course, there are some players in the market that are offering high prices. But the reality is that the British price at the moment is the highest price in Europe. Britain has the highest energy prices, electricity prices, not the highest gas prices, but the highest electricity prices in Europe. Now, the price cap is a little bit below the British average price, but still it's extremely high, and it's basically tracking wholesale. So the question is, what is the point of a protected tariff which just follows the same direction that all the other tariffs would be following anyway, because it's following the wholesale market? Well, the other markets are following wholesale too. So my argument would be, does this really provide protection? And a lot of customers jumped onto those variable price caps, because they're variable price cap tariffs, only to then suddenly be hiked up each period. And that means that they are now on variable tariffs, and prices keep going up. So they're feeling more and more vulnerable on those prices. So the question is, has it helped customers, or has it actually resulted in even higher prices than otherwise? The debate is still out on that, I would say. Next slide. So what has happened? The suppliers have failed, and because the prices have been brought down to a minimum, and suppliers that actually, in order to match that price, have gone out of business. So you could argue that therefore it must be lowering the price. Well, actually it's lowering the price and killing a lot of the players, but the net price isn't much lower than it would have been anyway. And certainly in the scale of things, it's not low, as we've seen before. Next slide. So the question is then, what are the policy options for suppliers? First of all, substitute imports. Well, we're doing that. Filling storage. Well, we're trying to do our best on that as well. Consumption reduction is happening because the prices are so high, and we're already seeing a lot of response to that. Question is, will it be enough? Well, we have very few policy measures to actually do that, but the prices are affecting that. We need to in that case, you could argue we need to let the prices rise. Wholesale reform. The wholesale price element is what's causing this price rise, not the retail element. The prices are rising in wholesale, and the retailers follow suit. Decarbonizing. We need to decarbonize quicker to get replacement generation, but it's a slow process in Europe because of all sorts of factors to roll out decarbonized energy. Tax reform. Move taxes out of energy. That's a good plan. Many are doing it. But there's only so much impact that will have because taxes are getting smaller and smaller anyway. Liquidity support, it's being done. Subsidies and compensation, you can clearly do that, but then you have to pay for that. And therefore, should that be done within the energy prices, or should it be done separately, so as to leave prices free to behave freely? And price caps. Well, I think as we've seen, price caps, of course, keep prices low, but someone has to pay for them, whether that's the suppliers by going out of business, the customers through the subsidies, and so on. So I would be generally hesitant with price caps. So the outcome is that, yes, we're taking measures, good measures, many things are being done, but really I think this winter we're at the mercy of the weather, and there's not a lot more we can do to reduce prices, and that's why countries are really talking about just giving handouts to customers. Thanks a lot. Cameron, over to you.
Thank you, Philip. A really comprehensive and fascinating overview of the situation in Europe. I'd like to move on to some of the implications. I'm sure the listeners will draw their own conclusions from what Europe has said, what Philip has said, but it really is, open to interpretation by some. But here's my attempt, and I invite comments, feedback, and we'll come to the Q&A session on this view and see if any of these sort of resonate with our participants. So I think what we've heard from Philip is that Europe's energy crisis could well become more serious, yet we haven't reached any sort of nadir, and we're facing a potentially serious situation in winter 2022-23 with the replacement of Russian gas not being able to be achieved in time, and also the issues of the capacity of storage to be refilled during the current year. The drought has created additional challenges for European energy markets in terms of constrained nuclear and hydro generation. And I think what we can draw from that is that Europe's challenges are likely to keep international coal and gas prices high, and the correlation, of course, with the export linkages with black coal and gas keep Australian fuel and therefore electricity prices high. And the graph of quarterly base futures prices that I've attached to the right from the AER as of August indicates that in terms of certainly the early quarters of 2023. Now, of course, like Europe, sometimes the challenges depend on the weather. And if the Australian summer happened to be hot and we reached high demand periods, and we also potentially face situations such as more thermal outages. And remember, we are entering a summer, which will be Liddell's last. So we have another thermal generator in Liddell leaving the market in April 2023. Outages will generally mean in high price periods, more greater use of gas power generation and more fuel bought from spot markets. So what we face in the coming months from Europe's linkages through the impacts on fossil fuel prices and the uncertainties in terms of demand is somewhat challenging outlook and an uncertain outlook. And in that situation here, domestic pressures for intervention in the market may increase. An environment of other cost of living pressures, issues such as continuing shakeouts in the retail market that might lead to questions about the sustainability of the DMO, would that be reopened? If we can move to the next slide. Thank you. And maybe some lessons to tease out and invite discussion. But what we heard from Philip was that while the crisis undoubtedly will provide the medium to longer term impetus for further decarbonisation in Europe, there is some way to travel in that journey. And the issues, as here, are in many cases unrelated to energy. New transmission, acceptance of new generation, new renewables takes time, and planning and community issues, as much as energy issues, create challenges in bringing in the new capacity and the bulk required to replace the exiting generation. What we've also seen is that in terms of Australia, we may have learnt that obviously through export linkages, we've seen that there is a price linkage to our electricity prices when you have a system using 48% black coal. Now, particularly in New South Wales, the generators are particularly facing competition from export markets. And what we've seen in the last winter is that our own domestic energy security cannot be taken for granted. We've seen the New South Wales government use its Essential Services Act 1988 to intervene in the market, use those powers and ensure that coal could be provided to domestic generators. We've seen pressure and discussion around extending and imposing the Australian domestic gas security mechanism. And we've seen at the recent Energy Ministers meeting, AEMO seeking and being granted emergency powers to intervene in the gas markets. Now, we hear a lot of discussion a lot of the time in Australia about the system we're moving to. What we have to remember is the system that we have now, the here and now. And that here and now is still, as I come back to it, 72% of NEM output last year came from a combination of black coal, brown coal, and gas. Take out the brown coal, where there's no export linkage, black coal 48%, gas 6.7%. Of course, that 6.7% can vary quite a lot. So therefore, the linkage, when you have the largest LNG exporter in the world in Australia, a major black coal exporter, fuel linkages to international markets, European pressures mean fuel pressures for our domestic generators. And so we just have to factor in that volatility for the combination of thermal exits and the linkages to international fossil fuel markets is going to be the name of the game. And when it comes to thermal generation, coal may be exiting, but we've got 2 new gas power generators under construction and an integrated system plan that proposes more gas power generation. So the world that we enter into is an uncertain one. There are pressures there. Europe has major implications for Australia. And in terms of Europe policy responses, what we've seen and we've heard from Philip is that attempts to suppress price pressures, a la UK price cap, which recently went up by 80%, can certainly create industry chaos, but it's no guarantee to protect consumers when wholesale prices are facing global pressures and growing at huge rates. And what we will see is obviously an environment of cost of living pressures. Electricity prices are a major issue for the voting public and for the economy, but governments will have to be mindful of the sustainability of their interventions. Anyway, those are my thoughts. And thank you very much for your insights, Philip. Well, the time's just hit 2 o'clock, which is probably 7 a.m. your time, Philip. You probably feel like a coffee. I would say on behalf of Marsden Jacob and all of the participants, we're very grateful for your time this morning, particularly at this very early hour, and very much appreciate your insights. On the screen, you should be able to see Philip's contact details and email if you have further questions to ask of him, and also my contact details there. I'd like to thank all the participants for joining today's talks live. This is part of a series run by Marsden Jacob, and we vary our topics in line with the company's practices. And the next one is Pricing Carbon and Economic Analysis in November 22 with Dr. Peter Kinraid and Amy Rogers from Marsden Jacob. But for now, I'd like to thank everyone for their participation. I'd particularly, once again, like to thank you, Philip, for your, as usual, fascinating insights into, really to the whole European picture and what's going on there. And I hope today's helped to tease out why that is relevant to Australia's situation. So thanks, everybody, and have a good day.
Thanks, everyone. Bye-bye.
Bye.